Hello everyone, and thank you for joining us today for this presentation about 1031 exchanges and Delaware Statutory Trust. We're glad you can join us, and hopefully you find this information not only useful and educational, but practical as well. This presentation is for accredited investors only and designed for educational purposes. There's no guarantees with any investment, and that includes Delaware Statutory Trust. There's always going to be risk. So you want to make sure that you're taking that into consideration. And if there's any doubts about anything, make sure you're also speaking to your CPA or other tax advisor. So with that, let's get started. A little bit about Perch Wealth. We've done hundreds of successful exchanges. We have over 100 years of combined experience. We're industry experts when it comes to 1031 exchanges and Delaware statutory trusts. We provide honest, objective advice to our clients. We take that very seriously. We do our own due diligence in-house. And so we take our role very seriously, and we want to make sure that we're providing the best advice to our accredited investors when they've decided or they're still deciding whether to do Delaware Statutory Trust investment. So we'll be talking today about Section 1031, like-kind exchanges. We'll also be speaking about the benefits of doing a 1031 exchange, as well as Delaware Statutory Trust. And we're going to be talking about the market environment as well, the current real estate market, interest rates, and let's get into it. So what is a 1031 exchange? Well, where does the term 1031 exchange come from? 1031 exchange is IRS code 1031, and it's a piece of legislation that in one form or another has been around for over 100 years, since 1921. And it's a very powerful piece of tax mitigation legislation where the IRS allows you to defer any gains that you make when you sell your investment real estate. There are very specific rules, which we'll get into throughout this presentation, about how a person can do a 1031 exchange. But for now, let's talk about some of the real estate eligible properties that you can invest in a 1031. So for example, as you can see on this slide, you can invest into fractional ownership shares of a property. You can invest into land. You can invest into multifamily, triple net properties. As long as it's real estate, you can take the money that you got from the sale of the asset that you just sold, also known as the down leg property, and invest that into another property that's of like kind, like you see on the left-hand side of this slide. But there are properties that don't qualify. We get this question quite a bit. Many people want to invest in real estate investment trusts when they're doing a 1031 exchange. However, REITs or real estate investment trusts do not qualify for 1031 exchange purposes. Another example are fix and flips. So if you've owned the property and you buy it, 6 months later you sell it for a profit, you can't do a 1031 exchange on that either. So on the left-hand side of the slide, you'll see properties as examples of properties that are eligible for 1031 exchange. And on the right-hand side, you'll see examples of what is not eligible for a 10. One of the most important rules to remember in 1031 exchanges is that you have to replace the value of the property that you sold to the new property in order to fully defer the taxes. So for example, if you sell a property for $1 million, then the property that you acquire or properties that you acquire as your replacement has to be a value of $1 million or more, because you sold the property for $1 million and now you want to buy something that's worth $1 million or more. So there's two ways to determine that. The first part is the equity component and the other part is the debt component. Not everyone has debt on their property, but for this particular example, we'll assume that you own a property that you sold for $1 million and you have $500,000 of equity that you're getting out of that sale, and then $500,000 of debt that you need to pay the bank. So selling a property for $1 million, $500,000 of equity, $500,000 of debt, you're going to have to buy another property that's worth at least $1 million. you're going to fully invest the $500,000 that you got on the equity component from the property that you just sold, and you're going to have to replace the debt value, the value of the debt, on the new property. So in this example, that debt component was $500,000. So you can either take cash out of your pocket and replace that, or you can get another loan for the property that you're buying into. In this market right now, it's very difficult to get a loan, and interest rates are also very high. But putting that aside for now, you want to make sure you're replacing the total amount of equity that you got from the sale and the debt component. Now, you can invest less than the $1 million. In our present example, you can invest less in the replacement property. But anything less than that $1 million, you're going to be subject to taxes. And every person's tax situation is different, so you need to make sure you're speaking to your tax advisor, like your CPA, like your tax attorney, to make sure that you understand fully what your tax liability could be. So on this slide, we see an example of two different clients, both selling a property for $1 million, and one person has $500,000 of equity and then $500,000 of debt. They buy a replacement property, they replace the total value, they invest the full amount of equity they got of $500,000, and then they take on more debt on their new property. So now they're exchanging into more property. That's a fully deferred exchange. They've deferred 100% of any taxes or gains that they've gotten because they've sold for $1 million and they're buying for more than $1 million. So they've done a successful exchange. The other person also sells for $1 million, $500,000 worth of equity, $500,000 worth of debt as well. But this time they invest the equity, but they get less debt into the new property that they're getting. So they're buying less property. As a consequence of buying less property, because they haven't fully replaced the total value of what they sold, they're going to pay taxes on whatever that difference is. One of the most important things to remember when you are doing a 1031 exchange is, if possible, is to plan in advance as much as you can. So you want to understand how you're holding the property. For example, you may hold the property that you're selling or you just sold, you may hold it in your individual name, you may hold it as tenants in common, you may hold it in an LLC or a corporation, and all these things become really important when you're doing a 1031 exchange, because the tax ID that's associated with the property that you're selling is going to be the same tax ID that's associated with the property or properties that you're now acquiring. So that becomes very important. The other part is to plan for a 1031 exchange. You want to make sure that you have a qualified intermediary in place. And we'll talk about that on the next slides that are coming up. But a QI, or qualified intermediary, also known as a 1031 exchange accommodator, has to be in place before you do your exchange. So these are very important things to consider. And you also potentially want to think about what property or properties you're going to be investing into. Because once you sell your property, the clock starts to tick. You only have 45 days to identify your replacement properties. And so this is a process where if you're doing a 1031 exchange, you really want to make sure that you're planning in advance. So let's talk a little bit about a qualified intermediary, also known as a QI. What is the role of a QI? Well, a 1031 exchange, typically what happens is you sell your property, that money goes to escrow, it's being held by escrow or a title company, and typically when you sell a piece of property, that's where it ends. You sell the property, the buyer of your property sends the funds to escrow, there's a closing, you get your money. But with a 1031 exchange, there's another component. You, as the seller of the 1031 exchange property, you cannot take possession of the money. You cannot take actual possession of the money, meaning if you take possession of the money into your bank account, or constructive possession. So for example, if your attorney or your CPA takes the money on your behalf. If you were to do that, you will essentially violate the rules of the 1031 exchange, and you will end up having to pay the taxes. So it's really important to have a QI. And what a QI really does is they're essentially babysitting your money while you decide where you're going to invest that money that you got from the property that you just sold. So think of a qualified intermediary almost like an escrow for escrow. So if you sell your property, the money typically goes to escrow. Now, instead of that money going from escrow at the closing to you, it goes from escrow to the qualified intermediary, and that qualified intermediary will sit on those funds and hold them for you until you give the QI instructions where to wire those funds. Understanding the 1031 exchange process. So, as we mentioned earlier, the first thing that's going to happen is typically you're going to sell your property, and then once you've sold the property, the money will go to escrow or a title company. They'll hold the funds on your behalf. And then once you have your QI in place, it's very important to have a qualified intermediary in place before you sell your property. The funds will go from the escrow company to the qualified intermediary, and they will hold the funds for you until you determine which property or properties you're going to invest in. Once you've determined which property or properties you're going to invest in, at that point you will notify your qualified intermediary and they will wire the funds to the owners of the property or properties that you're investing in or purchasing. The 1031 exchange timeline and identification process. This is probably one of the most critical components of a 1031 exchange. And the reason is that if you don't get the timing correct, you will end up paying the taxes. If you don't identify correctly, you will end up paying the taxes. If you don't have a qualified intermediary in place, you will end up paying the taxes. So it's very significant. One of the things about the timeline and the identification process is that once you have sold your property, you only have 45 days to identify the property or properties that you're going to be investing in. But within the 45 days, that's your time limit to identify. So if you're on day 46 and you decide that you're going to try and buy something else that you have not yet identified with your qualified intermediary, you're out of luck, because you have 45 days to tell essentially the QI and by association the IRS what you're going to be investing in. Once you get into day 46 and beyond, it doesn't matter. Whatever you identified is good to go. If you can close on it, you have 180 days. But if you can't close on it within 180 days, then you will likely end up paying the taxes. And again, that clock starts on day one as soon as you sell the property. Ways to identify replacement property. There are 3 rules to identify replacement properties. The first rule says you can identify up to 3 properties at any value. So, for example, if you sold your property for $1 million, you can identify another property for $1 million, a second property for $2 million, and the third property could be the Empire State Building for, let's say, $100 million. So the 3 properties could be any value. However, you have to close on at least one of those properties in order to defer the taxes. The second rule is called the 200% rule. And the 200% rule says that if you sold your property for $1 million, you can identify as many properties as you want with your qualified intermediary, but you cannot exceed 200% of whatever you sold for. So what that means is that if you sold a property that's valued at $1 million, you can identify 1 property, 2 properties, 100 properties, but they cannot the value of those properties that you've identified cannot exceed $2 million. If you sold for $1 million, 200% of that would be $2 million. So again, that's another rule that you can rely on. And then the third rule is called the 95% rule, and that rule says that you can identify as many properties as you want, but you have to close on at least 95% of the properties that you identified. So let's discuss some of the 1031 exchange benefits. One of the biggest benefits of a 1031 exchange is tax deferral. The tax deferral component is very important because that's essentially the reason that people are even doing a 1031 exchange to begin with. The tax deferral allows you to defer the taxes that you would otherwise pay on the gains that you made from that sale and take that money and put it into a new property, exchanging it into a new property. Under the tax deferral, you can defer the capital gains that you would otherwise pay, the depreciation recapture tax that you would otherwise pay. And so it becomes a really critical component to doing a 1031. It is the reason for doing a 1031 is to save money on taxes. Understanding the tax components of a 1031 exchange. So the long-term capital gains tax is 20% as of 2023. State income tax vary all the way from no tax in states like Florida or Texas, over 13% in states like California. As well as there's a net investment income tax of 3.8%. In addition to that, if you don't do a 1031 exchange, you're also going to have to pay any depreciation recapture tax. And everything you've depreciated on the property prior, 25% of that. So these taxes can really add up. And if you're not doing a 1031 exchange, you could potentially be paying over 30, 40, maybe even higher taxes on what you made from the property that you just sold. So long-term capital gains tax, state income tax, net investment income tax, depreciation recapture tax, these can all be avoided if you do a proper 1031 exchange. Defer or pay taxes. Well, if you defer, then you have the opportunity to take the money that you got from the sale of your property, invest it into another property, and continue to grow your income portfolio potentially, your investment portfolio, and save yourself from having to pay taxes on what you just made. As everyone knows, it's not how much you make from the sale, it's how much you get to keep. So tax planning is really important. And the 1031 exchange code is really designed to help you save on those taxes so you're not giving that money away to the government when you don't have to, you're reinvesting it in yourself and allowing your real estate portfolio to grow. Defer or pay taxes, let's look at a couple of scenarios. In scenario A, investor decides to sell their property for $1.8 million. They bought the property initially for $600,000. They've depreciated the full $600,000, so their adjusted cost basis is now zero. And they decide they're not going to do a 1031 exchange. So what are they potentially facing? Well, they're going to pay the 20% long-term capital gains tax, the federal tax. And if they live in a state like California, they're going to pay potentially over 13% state tax. And in this example, they're also going to pay net investment income tax. And they're going to have to pay a tax, a depreciation recapture tax, on all the depreciation that they've taken prior to them selling. So in this example, they've sold for $1.8 million, and they net, after they pay all these taxes, just over $1.1 million. If we look at scenario B, a person decides to sell also for $1.8 million. Their initial purchase price was exactly the same, $600,000. They depreciated it to nothing. They've depreciated the full $600,000. Their adjusted cost basis is also zero. They, however, decide they are going to do a 1031 exchange, and they're going to buy a property. They get to save all those taxes. That means that they fully deferred the $1.8 million that they just got for their property. Compare that to the other scenario that we just went through, where that person only received $1.1 million. So in this example, you're looking at a difference of, let's say, almost $700,000 difference between investor A and investor B. Now, that is pretty significant because that money that investor A paid, all those taxes, that's money that could have been working for them. Instead, that money has now gone to the government and they're working with less money to reinvest. So it's very important to remember that it's not just about deferring the taxes. It's also about understanding that when you don't defer the taxes, you're losing the potential income from the money that you just paid to the government. Whether doing a like-kind exchange is beneficial to you as an investor is very factually specific. So every investor should speak to their CPA or other tax advisor to find out exactly what their specific situation is. But one of the benefits of doing a 1031 exchange is that you can defer paying taxes on the gain, as we discussed. You can allow yourself to have greater purchasing power by selling a piece of real estate and then buying another one for that higher value that you just sold it for. You can potentially improve your cash flow. So if you've sold your property for $10 million and you bought it for $1 million, the return that you were making on the $1 million might not be reflective of the value of the $10 million. So for example, if you sell your property for $1 million and you were making $50,000 a year, so you're making 5% return on your investment. If you now sell that property for $10 million, you bought it for $1 million, you're making $50,000 a year, 5% return, and you now sell that property for $10 million, and now you're making a 5% return, that's $500,000. That's a $450,000. That's a pretty significant difference. If you don't do a 1031 exchange, you're not going to get that purchasing power that you get from reinvesting the full amount. You can also diversify or consolidate your real estate portfolio by doing a 1031 exchange. So if you own one particular piece of real estate and that value has increased and you sell it, you can now have the option potentially of buying more properties, not just one, but diversifying your real estate portfolio. And you can also expand into other areas or geographies in the United States. So you can sell your piece of property in Idaho and you can buy another property in Illinois. And you can seek to preserve your wealth and grow your wealth so that whoever you eventually leave your assets to, your money to, whether it's your children, your grandchildren, whatever charity you want to leave it to, a spouse, you have someone that you can leave it to, and they can get the benefits of you having done a 1031 exchange. So now let's talk about Delaware Statutory Trusts, also known as DSTs. A DST is a business trust created under Delaware law that allows people to hold real property in that trust. And in a DST, real estate owners or investors in that DST own a fractional share of that property that's owned by the DST. In 2004, the IRS came out with Revenue Ruling 2004-86. And in that revenue ruling, the IRS said that DSTs are a vehicle, a way to do a 1031 exchange. And that opened up a whole lot of opportunities for 1031 exchange investors today. So since that time, DSTs have become quite popular because most people doing a 1031 exchange incorrectly believe that once they sell their property, they have to go out and find their own property by themselves, typically retaining a real estate agent or a broker, finding someone that can help them find a replacement property, and then having to do their own due diligence and underwriting of that property that they're thinking about buying, and as well as sometimes having to secure their own financing and having to do this all within 45 days. And DSTs solve a lot of those problems, and we'll get into that in a moment, but essentially the DST as a solution for 1031 exchanges is very difficult to beat in many examples, many respects. DST advantages. Some of the advantages of DSTs is that you can diversify your real estate portfolio. This is probably one of the most significant benefits of investing in a DST if you're doing a 1031 exchange. And the reason is quite simple. If you're investing in one property, you take on more risk because if something happens to that property, for example, it gets destroyed by a hurricane and you're not properly insured, or the tenant in that property decides to stop paying you the rent or leaves, you are then in a situation where your income source, that one income source, has now disappeared for who knows how long. With DSTs, because the minimum investments are typically $100,000, you can diversify your real estate portfolio in the same way that you would diversify your stock portfolio, for example. So, by way of example, if you had $1 million, and that $1 million is everything that you had worked for your entire life, and someone told you that you should take that $1 million and put it all into one stock, that could be a problem, because what happens if that one stock was to drop? If the value of that stock was to drop, you have all your money in that one stock. You probably wouldn't do that. And so you would probably take that $1 million and spread it over multiple stocks, just to diversify and to help mitigate investment risk. It's the exact same thought and the same reason to invest the same way when you're investing with real estate. And with DSTs, you can do that. So, for example, if you sell your property for $1 million and you go out and you buy one property for $1 million, something happens to that property, you're really reliant on that one property. But with the DST, if you sell a property for $1 million, you could technically go into 10 different DSTs that are not only diversified by geography, meaning in different parts of the country, but they're also diversified by asset class. So, for example, you can invest in multifamily, senior housing, self-storage, industrial, and the list goes on. And you can also diversify by the sponsors, the companies that are managing these assets for you. So diversification is a critical component of the reason why people do invest in Delaware Statutory Trust when they're doing a 1031 exchange. The other reason is, as I mentioned a moment ago, is the low minimum investment. So typically $100,000 to invest in a DST. It's very difficult to find a good quality piece of real estate for $100,000 if you were just to go out and buy it yourself. It's not impossible, but it's very difficult, especially in today's market. With DSTs, the types of properties that are typically available to investors are institutional quality real estate. So the kind of real estate that endowments invest in, or pension funds invest in, or the large players in the world of real estate, those same assets that they get to invest in is now open to everyday investors for as little as $100,000. So you can invest the same way the big boys invest, and yet keep your investment to a minimum of $100,000 and diversify your investment holdings. Another benefit of a Delaware Statutory Trust is estate planning. Many times when people buy one property, for example, and let's say they have 3 different children, and maybe those children don't get along, or they don't necessarily agree on how that property needs to be managed. When that property goes to them, when the person who bought it dies, for example, it can lead to infighting. It can lead to problems as to, what are they going to do with the property? One child maybe wants to sell it, another child wants to keep it, another child wants to do something completely different. And so with DSTs, that can be planned for, and you can invest, rather than taking one property, you can invest in multiple properties, and then as part of your estate planning, you can leave a different DST to a different child, using that example. So it's another way to plan not only for what's happening now, but what's happening in the future. Another big benefit of DSTs is the quality of the assets. Like I mentioned before, these are all passive investments, meaning there's no management responsibility by the investor. And this is very attractive to a lot of investors. A lot of investors that own multifamily, for example, have dealt with tenants and dealt with property management companies that they have to respond to if the tenant says, my toilet broke, there's trash everywhere, whatever it may be, there's issues with managing a property. With Delaware Statutory Trusts, you don't have to do anything, meaning these are passive, 100% passive investments that are managed by very large, typically very, very large real estate companies. We call them sponsors in the industry, and they're the ones that are managing these assets for you. And typically investors will get paid every month, once a month. Now, again, I need to reiterate, there's no guarantee. Every investment, no matter what it is, could potentially lose money. But the DSTs, the way they're structured and the way they're projected, is that they will typically pay the investors once a month, every month, going forward once they invest. One of the other big benefits or advantages of DSTs is the non-recourse debt. When somebody sells a piece of property for $1 million and there's debt on that property and they need to replace that debt, the challenge for them, especially in this market environment, is that banks are making it very difficult to get a loan. And if you can get a loan from a bank, interest rates are very high right now. So it makes it difficult for people doing a 1031 exchange. Remember, you've only got 45 days to secure your financing. One of the greatest benefits of DSTs, especially in this market, is that many of the DSTs that are available already come with debt on the property. That debt is non-recourse to investors. And what that means is that investors are not on the hook for that debt. They don't need to sign the loan documents or provide their financials to qualify for that debt. But they still get the benefit of that debt if they need it for their exchange. So for example, if you sold your property for $200,000 and you get $100,000 and you pay off the bank $100,000, that means you have a 50% loan to value, a 50% loan, a debt component that you need to cover going into your next 1031 exchange investment. If you don't cover that, as we talked about before, you're going to have to pay taxes. So that investor can take their $100,000 and invest that in a DST that has a 50% loan to value, meaning that DST already has debt on that property, and the investor gets the benefit of that debt without having to qualify for it and doesn't have to go out and ask the bank for the financing. As well, when DST investors invest, everything will go in their Schedule E, just like the property that they just sold. So it's very similar. Plus, they get the depreciation benefits of owning real estate in a DST, just like they would if they went out and bought their own property. DST restrictions and limitations. So even though there's a lot of benefits that we just discussed with DSTs, there's a few things that investors need to keep in mind. The first thing is that these are not liquid investments. And what that means is that once an investor invests in a DST, there's no secondary market where they can go and sell their interest. It's legal for them to sell their interest. If an investor finds a ready and willing buyer, they're legally allowed to sell their investment interest. But there's no secondary market for doing that. So unlike, for example, when you buy a publicly traded stock, let's say Apple stock, and you buy that stock in the morning, you could sell that stock in the afternoon because there's a secondary market for that. It's not like that with DSTs. And so just like any other piece of real estate, it takes time to sell that asset if you find a ready and willing buyer. Typically, the hold time for DSTs is anywhere between 5 and 7 years. So historically, they're held between 5 and 7 years. So an investor that invests in a DST should go into it with the understanding that they're potentially going to be in this investment anywhere from 5 to 7 years, and that only when that DST sponsor decides to sell the asset, the company that's managing these DSTs, only then will they typically get their money back. When they get their money back, then they can decide what they want to do. They can do another 1031 exchange by themselves. They can invest again in a Delaware statutory trust, or they can cash out, or they can do a combination. But investors should know going in that they're in this investment anywhere from 5 to 7 years. DST limitations, or the 7 deadly sins. When the IRS blessed DSTs as a way for doing a 1031 exchange in 2004, there were certain requirements or limitations that they said were not allowed regarding DSTs. One of them is that you cannot refinance the debt on the property. So for example, if there's debt on the property for a DST, you cannot refinance that debt. Another example is you cannot do capital calls. Once a person has invested, for example, $100,000 in a DST, they've closed their exchange, the DST sponsor cannot come back and say, we need more money. Custom sample DST portfolios. One of the benefits, like I said earlier, of investing in DSTs is because the minimum is only $100,000 to invest in a Delaware statutory trust, you can diversify your portfolio and you can invest in different areas, different locations, different asset classes. So a custom DST portfolio can be created for you. And that's one of the things that we do at Perch Wealth. So when we have an investor, for example, that comes to us and says, I have $1 million to invest, we will typically create a custom portfolio for that client. And so, for example, they can invest in 4 different properties. Maybe one of them is senior housing, maybe one of them is self-storage, maybe industrial, maybe a triple net property or properties as part of a portfolio. So we will build a customized investment portfolio for someone doing a 1031 exchange that utilizes the ability to diversify and help mitigate investment risk for investors. And again, there's always going to be investment risk, but when you diversify, you're not eliminating the risk, you're mitigating that risk. So custom sample DST portfolios, as you can see in this particular example, you've got 4 different asset classes, 4 different geographies, and different sponsors. So what this allows you to do, again, is diversify. And diversification won't necessarily save you, but it'll certainly increase the odds of being successful. In conclusion, one of the things to keep in mind is that today's real estate environment is very different from even a few years ago. Interest rates, very high. Replacement properties are very difficult to find. Replacement properties that make financial sense are even more difficult to find. And you have demographic changes where people are leaving particular areas and moving into other areas. It's very important to know what tools you have available, what options you have available for you when you're doing a 1031 exchange. DSTs have grown a lot in popularity. They've been around for a long time, but they were really blessed, so to speak, or approved for 1031 exchange purposes in 2004 by the IRS in the revenue ruling. And as you can see in this slide, the interest in Delaware Statutory Trust has gone up considerably, and we project that to continue. It's still a somewhat small component of 1031 exchanges overall. There's a lot of people that are doing 1031 exchanges, but they don't know about Delaware Statutory Trusts. And part of the reason that we teach these classes, these educational webinars, is to allow people to know that they have other tools available to them. And as more people find out about it, whether it's CPAs, real estate attorneys, real estate agents and brokers, as more people find out about it, the more popular they become. And as a consequence of them becoming more popular, there's more big companies, sponsors as we call them, that want to get into the space and offer high quality real estate to investors and allow them to do a 1031 exchange without having all the traditional headaches that come with it. The risk factors, as I said in the very beginning, there's no guarantee with any investment. Past performance is no guarantee of future results. There's always the potential, just like any investment, including real estate, that you invest in something and it doesn't perform the way you thought it was going to perform. So it becomes really critical when you are deciding to invest in a Delaware Statutory Trust that you understand what you're actually investing in. And by talking to the Perch team, we can help you identify some things to look out for, what we think is a potentially good investment for you. And we talk to our clients. Specifically, every client gets their own tailored approach. No two clients are going to be exactly the same. And we want to understand your specific situation. And a lot of times, not only are we getting information from you, but we're talking to maybe your CPA or your tax attorney, if that's necessary, to really build a portfolio that fits for what you need. And while there are risks involved with investing in Delaware Statutory Trust, just like any investment, there's also risks involved by going out and buying your own 1031 exchange property by yourself. And so you want to make sure you're talking to the people that are educated, that are knowledgeable about this particular area. And at Perch Wealth, this is really what we focus on, is understanding 1031 exchanges and specifically Delaware Statutory Trusts and looking at what's out there in the market and what has the best potential for performing in the short term and in the long term. I want to thank everyone for joining us today and for listening in, and hopefully you found this educational. If you have any questions, please contact our team at Perch Wealth. You can find us on perchwealth.com. You can also see our phone number. We have representatives throughout the United States, and if you have a question about an upcoming 1031 exchange or you are currently in a 1031 exchange, we're very happy to help. We spend a lot of time helping folks that are doing a 1031 exchange and thinking about their options, and we'd love to talk to you. So thank you again for your time. It's very much appreciated, and hope to speak to you soon.